Welcome and hello. Welcome to the Go Plan video library that includes Greenleaf Financial Fitness Series and other financial professional series involved with personal financial wellness. This series, along with other videos, will be posted on our Go Plan YouTube channel, websites, and other social media outlets. My name is Jim Hiles, and as your host, I think it's important to highlight what financial wellness is and how tools like Go Plan 101 can help Americans achieve their goals and wishes. So, what is financial wellness? It is defined as the overall financial health of an individual. What it does for you is probably most important. It helps you increase understanding all things related to money. It can also help decrease stress, help you make better decisions, and perhaps most importantly, keep you on track as things change in the future. What's Go Plan 101? Well, Go Plan 101 combines web technology and educational content with behavioral change solutions, free software, and a huge resource center full of focused responses. Translation? Simple. Go Plan 101 is a cool site that helps people deal with their money issues so they can do what they want to do. And you also have the capability on our site to talk to a coach or go right to the resource. At the end of the day, financial wellness is only as good as the actions taken. So sit back, relax, and enjoy the video.
Good afternoon and welcome to the Greenleaf Financial Fitness Series, 20 minutes to a healthier, wealthier you. Today's topic is successful investing for retirement, where we'll cover some of the most important factors when it comes to investment success as we see them and what people should be aware of. As always, I'm going to take a few seconds to introduce the people responsible for bringing these financial fitness series to you. Jamie Greenleaf. Jamie is a senior partner and lead advisor with Cafaro Greenleaf. Next is Jim Hiles, who's here with me today. Jim is a senior partner with Greenleaf Financial, also the managing partner of First Capital Advisors Group. And I'm Jim D. I'm a financial advisor with Greenleaf Financial and your co-host for today. So let's take a look at the three phases of financial life. And we start here because we think it's important that we take a big picture perspective when it comes to investing and retirement, thinking along those lines, keeping a long-term perspective. So along the bottom, we see the time that we have to accumulate money. And over on the left axis is assets or money, right? The goal is to be efficient and to be able to invest and accumulate assets during that wealth accumulation phase so that we can then turn those assets into income in retirement during the wealth distribution phase. And at some point in time, we're going to turn our attention to wealth transfer and preservation for the next generation. What do we want our legacy to be? So now I'm going to turn over to Jim Hiles. I'm going to bring Jim in now, and he's going to talk a little bit about the importance of a financial plan.
Afternoon, everyone. This is Jim Hiles, and financial plan. I think it's kind of like building a house. We've talked about this before. You don't want to just go out there and buy a bunch of stuff and try to put your house together. You want to start with a blueprint or a plan, and the plan really does encompass all the things that are on here, and it should be one where they fit together. That's the other part. Retirement planning is part of it. Certainly investments are a big part of it. We're going to be focusing on that investment thing today. So the next place you'll go to is, where do you typically save and invest money? Well, there are a number of places to do this. You've got 401ks, HSAs, your retirement plans, your personal retirement plans, things like IRAs, and then your personal taxable investments. So those are the different places you can start to accumulate money. Let's talk about really how to do it or what to look at. Well, Einstein was a pretty smart guy. There he is over there on the right. Compound interest, eighth wonder of the world. He who understands it earns it. He who doesn't pays it. It's an interesting quote. And I think there is, for all of us math geeks out here or non-math geeks, it's pretty simple. What we're trying to do is make your money work for you. And you have to understand that a large amount of success in investing has to do with the power of just putting the money to work and letting it compound. And the magic of compounding, you look at it relatively simple in something called the Rule of 72. So this basically says, you can do it a number of different ways, but if you take what your rate of return is or what your desired rate of return is or expected rate of return divided into 72 is going to take you the number of years for that investment to double. So if I'm thinking I'm getting 6% on my assets, then I know that according to the law of 72, 6% divided into 72 is going to be 12 years for that asset to double. Now, I know a lot of money out there is sitting in zero bank accounts, which is not going to work in the rule of 72 at all, or even 2% money. It's going to take one heck of a long time, actually 36 years at 2% for your money to double, which is essentially what a CD rate is. So that's usually not going to work, but keep this in mind when you're looking to figure out what the expectations are going to be for your money in the future is understand the law of 72.
Great. So, right, let's talk about inflation. And one of the reasons that the rate of return that we earn on our investments is so important is because of the erosion of inflation, right? At just 3% inflation, which is what we've seen traditionally, your purchasing power of a dollar is cut in half. So that means that today's $5 beverage at a Starbucks is going to be $10 25 years in the future, right? It's hard we don't really typically think in future dollars, but we have to when it comes to investing. It shows us why the rates of return that we earn are so important. Because of life expectancies getting longer, we also think that it's affected women more disproportionately. We've seen that time and time again. So we'll talk a little bit about longevity, right? That's another risk that has become a growing concern with each generation. Life expectancies are extending and people are living for much longer periods of time in retirement. So you actually need to consider still continuing to grow assets even though you may be retired. If you look at this graph here, for an individual man, there is a 75% likelihood that he will live to age 79 and a 25% chance he'll live to age 93. And you can see that the women have slightly longer life expectancies, but as a married couple, for at least one of those individuals, there's a 75% chance one of those people is going to live to age 88 and a 25% chance to 98. So longevity plays a major role in paying attention to the rates of return that we earn.
I think that's a huge point, particularly for a lot of people in retirement or approaching retirement, that you say you're conservative, you don't want to lose your money, and we get that. But if you were to invest money for 10, 20, 30 years, you may not want to be as conservative as you think you might be. So that is kind of a big deal, is investing once you hit retirement to accomplish the fact that you don't want to run out of money, so you have to take on some risk. But one of the ways to deal with risk is to diversify. We see this a lot. Let me just go really simple. If I've got the graph on the left, I've got 3 different investments, and let's say they're in the quote-unquote stock market or some other similar investment. And they're all going to go up and down at the same time. That's not diversification. Even though they may be different, they're still involved within the stock market or whatever it may be, the real estate market. They're going to go up and down at the same time. That's not what true diversification is. True diversification is where you have some of your portfolio is going to do exactly the opposite of some of the rest of the portfolio. And generally speaking, it's an upward trending line because the growth of the economy, particularly in the United States, and around the world on top of that, is going to continue to grow at some pace over time, even at inflationary rates. So you may think that all of your portfolio has to be going up in the same direction all the time. That's not necessarily the best way to look at it. You need to have things that operate differently in different environments.
Right, let's talk about the dreaded emotional roller coaster.
Yeah, speaking of different environments, right? So, we deal with human emotions in terms of how to make your money work, and everyone wants to enjoy the ride. And at some point, you're going to have to work counterintuitively. In other words, when things feel the best, that's usually the worst time to invest. When things feel the worst, that's usually the best time to invest. One of the best ways to get around this whole thing is just to go back to the financial plan. If you understand that this investment that you're in behaves a certain way, that there are going to be ups and there are going to be downs, and you have a long-term view on that money, then you should be able to ride out these waves. And that's probably the number one issue that people deal with, is they get nervous at the wrong time, or they get euphoric, meaning they'll invest at a market top, and that's not the way to do it. Build a plan and stick with the plan. Okay,
I think we'd all acknowledge that there's a little bit of information overload out there, and we all carry around what could be a stress machine in our pockets. These are some sobering facts. A lot of distractions. The average person checks their phone 150 times a day. Spends 2 hours on social media. Obviously, there's a lot of factors on there that get people to start thinking about things they probably shouldn't be during the course of their day. It doesn't end there. It's the TV, it's the radio. There's a battle for our attention going on, and that doesn't really line up or coordinate very well with the slow, steady, disciplined investment approach. It encourages a feeling of I should be doing something different, or I should be reacting to the news that I'm seeing. So we're trying to discourage that.
Yeah, and it's too much information. Turn them off. I mean, focus on this. Look at the plan. Let's talk about the plan, the balancing act you got to have, right? So we're going to talk about risk a lot today. So it's important you know your risk tolerance. You're going to be given an opportunity to complete a risk tolerance quiz. So you need to understand what your risk tolerance is for money. You need to think about where you're trying to go. What are your objectives? What are you trying to achieve in terms of expectations? How much are you willing to risk? And you have to kind of get a feel for where the current conditions are. Now you got to balance that, right? You got to balance it with, well, do I have taxes or expenses I got to take into consideration on the money? Should I be more preservation oriented, or should I take advantage of opportunities? And then I might have some preferences. I might want to stay away from tobacco stocks. I might want to take advantage of international stocks. Now, all that should be balanced into making a portfolio that's basically personalized.
Okay, many of you may have seen this giant engine in other presentations we've done, but we use it here to illustrate the point that investments are the engine that drive our plans. So we started with plans, and now we're talking about investing, and we all want an efficient engine, right? So let's talk about some of the investment vehicles that we can use, to take care of our long-term investment plans. Obviously, we have CDs, annuities, stocks, bonds, commodities, real estate, and any of those things on the left there, or most of them, can be owned individually, or then, of course, with stocks, bonds, commodities, real estate.
Let's break them down.
Can be combined.
Let's break them down a little bit, right? Let's make this a little easier. So if I'm going to invest my money, I'm going to go to the bank. I'm going to buy a certificate of deposit. I'm getting how much on a CD these days? 1 year CD?
Probably less than 2.
Less than 2. What's inflation?
On average, 3.
A little more than 2 right now. So
right now it's a little less.
Right, historical average closer to 3. So not only do you have the opportunity of keeping your money safe, but you're going to go backwards in terms of inflation. And by the way, those are taxable interests generally, so you might even have to pay taxes for the benefit of staying in a CD. We like them because they're guaranteed. They belong in some portion of the portfolio. But if you're trying to move ahead, probably not the best place to go. So tell us a little bit about annuities, Jim.
So annuities are basically a contract between an individual and an insurance company. There are certain guarantees. They're typically tax deferred unless you're taking interest immediately. So again, they have their place in the world. It's sometimes part of a well-diversified.
So should I own an annuity?
There's no right or wrong answer to that unless we know all the facts, right? So
okay.
there's plenty of.
Why would I want to?
If you need a guarantee, if you need a certain set, there's different types of annuities. So we can start with that, right? A fixed annuity is basically a tax-deferred CD. If you want a guarantee and you need a guarantee and you have an income shortfall that you need to protect, annuities are great for that.
Okay, so it might make sense to own one. There's no yes or no answer.
Sure.
So let me tell you a little bit about stocks since we're talking about fun things like this.
A lot of people are afraid right now.
Why?
Because the stock market is high.
Is that right? So the stock market's been all-time highs over 100 times in the last year. So when is the high? It will always be another high.
Sure. Right.
So when you look at stocks, and we're making fun of it a little bit. By the way, the stocks are essentially ownership certificates in companies, and generally the people pay for the value of the stock based on the profits or cash flow that a company is planning on making. So when you look at a stock, you're buying it for essentially a future cash flow, future profit stream from that stock. If we think it's going to make a lot of money in the future, I'm going to pay you more for that stock. If it's going to make less, I'm going to pay you less. And you have different, when people say the market, keep in mind there are over 100 different stock markets out there, 100 different stock markets. So when you say the market, I often ask the question, which one? Because not only do you have a lot of stocks, you also have a lot of different markets out there too.
Which brings us to this, right?
Okay. So when you look at it, each each asset class, these are called asset classes. If you look at this chart, you can start at the bottom left. We'll start there at cash, and you'll look at those high rates of return versus low rates of return, and then high risk versus low risk. So it kind of makes sense that cash is low risk and low return. When you start moving up this progression, you go from cash to bonds, international bonds, real estate stocks, and international stocks. Typically speaking, international stocks have been the highest risk, but they've also given you the highest rate of return. So which one should you put all your money in, Jim?
The one that's going to do the best this year. You bring out the crystal ball, right?
Exactly. Well, if you look at this, so this is history, guys. Let's look at history. This goes back from the history of the stock market. And the line on the top there, that blue line, is small company stocks. Pretty risky. But on the other hand, if you think long term, you absolutely want to put your money in stocks. And we believe in the economy continuing, the global economy continuing to be this way for a long period of time in the future. So we think that if you were to guess, yeah. Now, what do you know about stock market crashes, Jim D?
They go down a lot quicker than they recover. We know that.
Yeah, but even you look at it long term, they kind of even out, don't they? I mean, yeah, there are down moments here, and there are down periods of time. But a long-term investor, if you're looking to make money, that's the price you have to pay.
Yeah, with perspective, it looks a lot smoother than the media would have us believe, right?
Yep.
So we see the average on the last slide, 12%, right? I would tell people that the average is kind of, and oftentimes if you look at it the wrong way, it can fool people, right? They get in hearing that something has an average return over the past 10 years of 12%, but what they don't realize is that in order to get that average, they sat through a lot of volatility. You know, if you got in say, 1999, you didn't see 12%, right? So immediately, if people got in for the wrong reasons, if they didn't understand that we have to take a longer term perspective, they immediately feel like they got in at the wrong time. And what we're trying to do is help people understand that there is no knowing when the right time is. People have been talking about a market drop for I don't know how many years now, right? I mean,
yeah,
last 3, 4, 5 years, the market's been setting new highs, and a lot of people's been sitting on cash has been sitting on the sidelines waiting for the pullback, and they've missed a big part of the upside. So put away the crystal ball. No one has one. The media is definitely not doing you any favors, and that's why it always comes back to a plan and understanding what your risk tolerance is.
Yeah, to me, this is kind of the sleep number. You all understand what that means, right? It's that that bed your wife has a different number than you or whatever, bed. Right? And whatever your sleep number is, your comfort level, where you think you're comfortable sleeping at night. Well, I'm just going to bring that back to the investment business and we talk about, well, how do you know the risk with an investment or a portfolio, and what does that mean to me, and am I comfortable with it? So every single investment can be plotted. In other words, every single investment out there has a risk and return history. And you can plot them, like these plots up here, like there's one in the middle right in here, that says that I've got a risk about this much and I got a return about that much. And by the way, that's the S&P. That's the U.S. S&P market. Has a risk of about 14, relative number, just a sleep number concept, and a return about 9 over the last 10 years. So, but there are other things which could do better. And essentially what we try to do is figure out where you sit in this risk profile. And then we make a portfolio which is less risky than the stock market, hopefully, and hopefully with a higher rate of return. So you can actually find different places. Like I'll give you a quick example. This green dot right here, this square I should say, that means that I have a portfolio that I put together of diversified stuff that I have a lot less risk for about the same rate of return as the S&P. Think about that. A lot less risk. Look, it's almost half the risk, maybe a little more than a third of the risk, but I get the same rate of return. That is how you figure out where you should be in terms of risk rate of return in a portfolio. Everybody has a sleep number, what makes them feel like they can sleep at night and take the ups and downs. You should be able to plot that and put it in relationship with other things out there and build a portfolio based on where you think that should be. That doesn't necessarily mean we're going to try to time the market. We believe that you should be in stocks. Everybody should own stocks, no matter how old. It's just a matter of how much. And there's probably a converse to that, which means that we probably should all own bonds, but to what degree? And real estate and international stocks and commodities. It's just a matter of finding the right mix that is the most efficient in the current market today that can ride out these ups and downs over time for you.
Okay. And that kind of plays right into this next slide about expectations, risk, and reward, right?
It does. So every portfolio can be plotted. That means that you can find the most efficient portfolio for you. So if you come back and say, well, my risk profile is moderate, meaning I'm kind of a middle of the road type of risk taker, then I'm going to probably look at a portfolio that has this type of pie chart. That's going to suit me well for my return expectations, but also protect me well when the markets are going sideways or down.
Right. So this is showing diversification by asset class. What we saw in that last, we didn't talk about that yellow lonely square down here on the screen, which was obviously does not fit into that efficient frontier at all, right? I mean, that's just by being diversified, you don't automatically find yourself in one of these good-looking portfolios. Sometimes people are diversified and they're taking far more risk for the returns they're getting.
Yeah, so you kind of relate this back to everyday life. It's like, okay, you need to know your risk profile, and then you need to look at your objectives, what you're trying to achieve. You need to look at your time horizon. You need to understand that different investments are operating in different ways. You can't necessarily control the future. So the best you can do is put together a portfolio which is designed to ride out in your level of comfort the trip from here to there. And you got to take into consideration the impact of inflation and taxes along the way. And that means you kind of go back and look at where we started, which was, put these numbers to paper. Let's get together and talk about where you're trying to go. Let's map out what your risk profile is and then figure out what the portfolio should look like. That means within the 401k and outside of the 401k.
Great. So if you would like, we're up on our 20 minutes already, time flies. If you'd like to take a free risk assessment, look for the follow-up email to this webinar and click on the link, and it'll take you to a series of questions that'll help us determine what your risk profile is. Then you can see from there if your investments line up with your risk tolerance. And what we often see is they don't. So if you need help seeing if your actual investments line up with the risk tolerance, call us, email us, follow up.
So we covered a lot of ground, and let's just summarize. It's time to put this information to work. We live in a wonderful and a free country, but it's up to us to take responsibility and move forward, particularly on our personal financial wellness. So let's take some action here. Let's go and explore this financial stuff. Take a buddy with you if you need to. Have some fun. Learn a little or learn a lot about what you can do financially. These videos and websites, I hope you enjoy. I think they're great. But if you're like me, sometimes you just want someone to talk it out with. So seek out coaching from our site from professionals who've been vetted to provide you with complimentary initial consultations as being part of the Go Plan 101 experience. If you've not started your planning, or even if you have, use today's video to explore the area of concentration. Make sure you understand how it impacts you. My favorite quote is, life doesn't go in a straight line. You need to stay on top of it. So consider subscribing to our newsletter or our YouTube channel. Please reach out to me if you want more help or have questions. And lastly, thank you for listening. Now, go plan and go attain your financial wellness goals. Jim Hiles signing off for today. Take care.